Oh, thank you so much, Judy and Tracy and everybody on the Savvy Ladies team. And many of you have joined today. You are newsletter subscribers of mine. I'm so happy that you're attending today as well. And you will learn a little more about the Savvy Ladies helpline at the end. And as Judy said, I've just started volunteering as one of the financial professionals, and it's a really exciting opportunity to provide help back. So with that, I'm going to get started, and I'm going to try to keep my slides and remarks to about 30 minutes, 35, we'll see, because I know there's going to be lots of questions at the end, and you can start chatting in your questions whenever you want, and Judy and Tracy will be moderating those. Okay, so let's get started. So that's me, and we're talking about how to generate monthly income from investing. And as Judy said, I'm a financial advisor, and I'm also what's called a certified divorce financial analyst. So I have really two types of clients. I help men and women throughout the divorce process, but I also help manage people's retirement accounts, their investment accounts, whether you're single, married, divorced, widowed, or whatever. Okay, so first of all, I have to give a disclaimer. If you've ever seen a financial advisor present, you're going to see the disclaimer. I'm going to be talking about certain investment options. I'm going to be talking about different rates of return, and you just need to know that all investing carries risk. This is educational. I'm not encouraging you or soliciting you for anything. Please take this as helpful education, as a foundation to just further your financial knowledge and investment literacy. So those of you who know me know my story. I go by the Options Lady. My website is the Options Lady, and I made my first stock trade at age 24. I had received a $1,600 inheritance from my grandmother. Age 24, $1,600 that I could have spent. Instead, I started investing in stocks, and I was a millionaire before I turned 40. And my book, Every Woman Should Know Her Options, became an Amazon bestseller in 3 categories, literally about 4 or 5 months after I published the book. And people always think, wow, she turned $1,600 into $1 million. That's not that simple. The key to my success was constantly adding small amounts of money to my retirement plan at work. And also, anytime I had $500 that had accumulated in my checking account, it went to buying more stocks. And I had a system that I developed that once in my non-retirement account, in my stock brokerage account, whenever stocks would hit a certain return, whether at 10% or 30%, I would sell it and use that capital and buy something else. And that's how I developed a very diversified portfolio. It's just a system that I put together. And the secret, today we're going to be talking about generating income from your investments. But before you have that, you have to do the work of actually saving while you're working and putting money aside so that there's a pot of money ultimately from which you can withdraw income. So this is an example. These pictures are not pictures of my real clients, all right? I'm not going to, for privacy purposes, I can't show a real picture, but I wanted to give you ideas of the situations that my clients are in and how I'm helping them generate income from their savings. So, so basically, I'll give you an example of one client I have who's retired. She was able to save money throughout her life. She was a teacher. And so she now has money in a brokerage account, 2 individual retirement accounts. And she asked me to generate enough investment income from her account so that she can withdraw the same amount of money every month in order to help fund her living expenses. She gets a pension because she's a teacher, but the pension obviously isn't enough to cover her living expenses. And the goal is, how can I invest her money such that when she's pulling money out every month, she's not spending down the whole account? can I generate enough income from a variety of investments that there's money that she can pull out every month without hopefully having to spend down the principal. Then I have a client who's in between jobs, and she had stock from a previous employer. She received restricted stock units and stock options. And when she left the employer, she had all this money in one stock, which is really risky to have all your eggs in one basket. She's been for about 1.5 years having to live off that. And what we do is, and I'll talk about it a little later, we do something called covered calls, which is an option strategy where we are able to agree to sell her stock at a higher price in the future, and she gets income today to do that. So it's a way to quote unquote rent out stock you already own for income. And we'll talk a little bit about that later. And then most of my clients are divorced or single mothers. They may have school-age children. Many of them have adult children now. We've worked together a while. And this is a typical situation where the client has received her share of the divorce settlement. Maybe they sold a house, and so there's money that's not in a retirement account or whatever. They've just split all their assets, and she withdraws money periodically. It's not a planned monthly thing. Anytime that she's got extra expenses that child or spousal support isn't covering, or perhaps support has ended because the kids are older. So this is one of the most challenging things because most people want a savings account or an emergency fund to pay for unexpected things. We get that, right? You can't always anticipate costs, even if you have the best budget. So when you have an amount of money that's sitting there, I want to keep it invested for growth, but I also have to make sure that it's liquid enough and conservative enough that she can take out, thousands of dollars at a time when she needs it. So those are examples of the type of people I work with. Okay, now I know you're not going to be able to read this chart. That's okay. But I just wanted to show you that this is actually the math behind the overview. But let's take the simple question. If you had $100,000 that you had saved and you had to take $500 out a month to help subsidize your living expenses, how long would that money last? So think about it. If you have $100,000 and you've got to take out $500 every month, how long would that last? Well, if you see on the left here, if you were having it because you're nervous, you don't want to take risk, if you had it in what we call a high yield savings account, which is paying right now not even 1% a year. American Express has an online savings account that you get 0.4% a year. If you invested your $100,000 in that high yield savings account and took out $500 a month, that money would last you 18 years and then it would be gone. Conversely, if you invested it in a portfolio of stocks, bonds, REITs, a whole bunch of whatever it is, and you were able to earn 4% a year, maybe a combination of dividends or interest or what have you, your money would last 28 years. So when occasionally women will come to me and say, I have this money and I'm too afraid of the stock market, I just want to save it. She's actually taking more risk than somebody that invests the money because her money will run out sooner. So that's your trade-off. If you have a very conservative investment outlook and you put something in a savings account, your money is going to last much less time period than if you invest it. However, if you invest it, the stock market, it goes up and down. So, but if you don't get this concept of all the slides today, this is the most important concept you need to wrap your head around. That if you don't invest your money at some rate of return, you'll likely run out of money, because the person who is going to deplete their money in the next 18 years, unless they get an infusion of new money, it's gone. So that's just a very important point. Okay, let's talk about where we are these days. There is no free lunch for savers these days. If I go back 30 years to 1991, a 1-year CD, a certificate of deposit, was paying 7%. So I could literally put my money in a bank CD, go to sleep, being in a coma for a year, and I've made 7% on my money. If I had $100,000, a year later, I'd have $107,000. That's pretty darn good. But also 30 years ago, mortgage rates were much higher. A 30-year mortgage rate was 9.75% on average, based on my research. Now we look today in 2021, and you're lucky if you can get 0.5% on a CD, meaning that you tie your money up for a year. You have to tie it up for a year. You can't just be pulling it out. There's penalties. And if I had $100,000 and I had a CD that was paying, let's call it 0.7%, I make $700 on $100,000. That's nothing. But mortgage rates are much lower. So these days, borrowers are better off and savers are worse off. And this is just the cycle of interest rates. And throughout your life, you're going to see interest rates go up and down. But the point is that it is really hard to make money as a saver. You have to be an investor, and it will change. When interest rates go up, you'll be able to be more conservative with your investing. All right, I want to spend, this is a very complicated, detailed chart, but I want to spend actually about 10 minutes on this chart because it's important just from a financial literacy standpoint that you understand, if you're not already familiar with all these things, what are some of your options for investing for income? So let me explain how this works. On the top row, I say what your annual pre-tax interest, dividend, or premium will be. Basically, I say pre-tax because different investment types, the income is taxed differently. So we always want to think about the pre-tax. If you're investing in a 401k or an IRA, an individual retirement account, you're not paying tax on this income while it's still in that retirement account. Then I have here on this column, if I had $100,000, how much would this percent relate to in terms of dollars per year? And then this last column is loss of principal risk. What does that mean, loss of principal risk? Well, if I put $100,000 in GameStop stock, with GameStop, or give me some other meme stock or AMC that was going wild, I have a very high risk of principal loss. I can invest $100,000 and 2 weeks later I could be down to 70,000, or conversely I could be up to 120,000. So a lot of people don't like investing when they're not positive that they're going to have their baseline amount come back when they need it. And this is why I routinely have women reaching out to me, well, men too. Hey, Laurie, I just sold a house. I got all this money. I want to buy a new house, but the market's so high. I want to wait. And I'll say, okay, you're going to rent for a while. When are you planning on buying a house? Oh, 6 months. It could be 5 years. Any money that you're going to need in the next 2 to 3 years should not be invested in the stock market, because there's too much risk that your principal may decline the very time you need to pull the money out. Obviously, the stock market is great for long-term wealth. How do you think I became a millionaire before I was 40? I wasn't even in real estate. I was completely in the stock market, but I was there for the long term. So that's the risk reward you face. The higher the return potential, the higher your risk of losing the money that you started with. So let's go through these. We've talked about, I put them in sort of lowest rates to highest. So we talked about a high yield savings account. Right now, if you're in a regular savings account, you're making very little. So you can do a high yield savings account. You can go online and find those. And American Express, I know, is 0.4%. If you had $100,000 a year, or if you had $100,000, you'd expect to make $400 in a year, and that would be taxable because that's interest. That would be taxed like ordinary income. But your loss of principal is very low. It would be really astounding if you got less than $100,000 back. Like it's not guaranteed, but it's FDIC insured. The next step up in risk is the certificate of deposit. A 1 year is going to earn right now a little more, say 0.55% on average. There's different deals out there, but you have to tie your money up for a year. Otherwise, you may not get all the interest that you're expecting. Now, you can do these easily. You don't need a financial advisor or anything. You don't need a brokerage account. You can just do those. Now the next level of risk would be government and corporate bonds and funds. You'll need a brokerage account or a retirement account to do that. And right now, because interest rates are so low, on average, you're going to earn 0.5% to 2% a year. And what is a bond? A bond, if you have a government bond, you're lending money to the government. If you have a corporate bond, you're lending money to corporations. That's a real simple high-level overview. Bonds can go down in value too. So there is a risk of principal loss, but it's fairly low if you have short duration bonds. 10 years from now, you might be able to get a lot more interest on your bonds if interest rates go up. The next level of risk is what we call high yield bonds. And when I say funds, you can be buying individual bonds, or you can be investing in mutual funds or exchange traded funds, ETFs. High yield bonds are often called junk bonds. They pay higher rates of interest than the previous category because they're more risky. So they're just, if a company goes bankrupt, there's an order of who it pays first, and the bondholders are paid before the stock shareholders. Okay, I'm going pretty fast here, but I want to just go through these so you at least are introduced to these. The next again, this is all my own opinion, by the way. You might find other financial advisors have slightly different views on this stuff, so it's just my opinion. Preferred stock and funds. Again, the yield is going to be a little higher. So if I have $100,000, I can expect to potentially earn $4,500 or $5,000 a year. Again, not guaranteed. This is just, these are assumptions and the best that I can in terms of what you can expect. And this would also change. I mean, this is just, I just, again, want to say I'm not promising this result. You see with my footnote, these are estimates and not guarantees of rates that can be achieved. So preferred stocks are sort of a combination between stock that you've heard of in a company and bonds. And I love this asset class. I really like it. And then the next one is U.S. common stocks and funds. This is the stuff you know about. This is Apple. This is AT&T. This is Chevron. This is Google. These are, Campbell Soup Company. Some stocks do not pay a dividend. Amazon, Facebook, Google. You only make money in that stock if it goes up after you bought it. It's not an income generating mechanism. It's a way to get growth and capital appreciation, but if it's not paying a dividend, you're not earning interest. Other stocks pay dividends. AT&T, for instance, pays a dividend of over 6% a year. What does that mean? That means if I have $100,000 in AT&T stock, every 3 months I'm getting a dividend. And if the yield is about 6% a year, it's a little more than that, then every 3 months I should be expecting about 1.5%. The problem is AT&T stock isn't going to stay the same level. It's going to either go up, down, or stay flat. And so you're earning income, but you also have some risk that the stock price will go down, maybe it'll go up. I'm going to go through a little more, a few more. Now we have REITs, real estate investment trusts. You can buy these in a brokerage account or IRA, or you can buy privately traded ones. I only invest in the publicly traded ones. And what's a REIT? So basically, common ones are, it may be shopping malls or office buildings or assisted living facilities where you're actually sort of getting the rents. Instead of you owning the real estate, you're part of a fund and the rents are being flowed through to you. A lot of people like REITs. They're taxed a little differently, a little more administrative burden sometimes come tax time. But you don't want all REITs because then you're putting all your eggs in one basket, all real estate. And certainly commercial real estate had some tough times during COVID. And there's mortgage REITs. They pay a little more. You're basically investing in mortgages. And then the last two rows, covered calls. I've highlighted this because this is what I talk about in my book, and this is what I do for a lot of clients. Covered calls are on stocks, and you can get the quarterly dividend plus option premium. You basically agree to sell your stock at a higher price in the future in exchange for guaranteed income today. And I'll talk a little more about that in the next few slides. And then here's some other income generating assets. MLPs are master limited partnerships, usually energy pipeline companies. So the energy companies are paying rents, if you will, to use the pipeline infrastructure that flows to you if you're an investor. I know we have a lot of ladies on here today that are real estate investors, real estate notes, where you are basically, I'm oversimplifying, but you're the bank. You're basically an alternative when somebody wants to purchase real estate, you're lending them the money. It's not that simple, but that's the overall concept. And then there's something called peer-to-peer lending. There have been a lot of sites popping up over the past 5 years where instead of people who have credit card debt, they may, instead of paying 22% to the credit card company, they may borrow from you. You're allowing people to, you're providing people with consumer debt and they're paying interest to you. Again, not that simple, there's platforms, but the bottom line here, now that I've rambled for 10 minutes, is there's a plethora of ways to generate income from your money. And the sticker point is that I've shown you examples on $100,000. If you have $200,000 to invest, then you would double these numbers. If you only have $50,000 to invest, you would have these numbers. So the stickler is that you've really got to do the work first to save and accumulate this money before you can actually use it to generate income that you're going to spend. And that's why most of my clients are not young women, they're women who have accumulated savings over the years. Okay, I just have a couple more slides. Okay, let's talk about annuities. I wasn't even going to discuss annuities in this, but one of my clients said that her mother was considering an annuity. So what is annuity? Well, when you get Social Security, that's an annuity. An annuity is a guaranteed stream of monthly income. So when you get Social Security and you start collecting that at 67 or whatever age, you're going to get that same amount until you die. Same with a pension. Maybe you worked for a government or the private sector where they had a pension. When you retire, you're going to get the same amount of money every month. You can do that yourself with an annuity. I could take $100,000 and buy an annuity. And in this case, I don't sell annuities. They're not my favorite investment option because the people who sell them usually get a pretty good commission up front. And I just feel like there's better ways to invest, but it is a feasible option for some. It might be a very good option for some. And what I did here is I just went on to Schwab, and they have an income annuity estimator. You don't need an account at Schwab. You could go on there and do this yourself. And I put in, I know you probably can't read this. I need my reading glasses to read this. I put in my birth date, August 30th, 1968. I said I want to invest 100,000. And what I highlighted here is that if I want to take out $500 a month, it's a 20-year certain, basically telling me that if I die before the 20 years, my beneficiary will get that $499 a month. So I know that if I'm dead, they're at least going to get paid for 20. If I live for 10 years, they're going to get paid for another 10 years. Now, over here on the right, I put annuities have tons of disadvantages. You can't just change your mind and get your money out. If you try to take all your money out and you get that $100,000 back, there will be surrender fees. There will be charges. You will lose money in fees. So when I look at the options here, if I put 100 in the green font now, if I put $100,000 in a high yield savings account, as we saw in the first slide, that's going to last me 18 years. If I invest and get a 4% return a year, that'll last me 28 years. And the annuity here is going to last me 20 years. You know, getting $500,000 or $500 a month from all these options, right? So why would I choose the annuity when it's not liquid? Whereas with the savings, I know that if I change my mind after 3 years, I can get all the principal that's still there back. And with investing, I can always change I can change my allocation. I can take more money out than $500. So when you sign up for an annuity, you're basically saying, in this case, I'm going to get $500 a month for 20 years, and I can't really change my mind. And if I need more than $500 a month, I'm sort of hosed. If I want to take less than $500 a month, I'm sort of hosed. Sure, there you'll find annuities where there is some flexibility, but flexibility has a price. So, however, if you are somebody that you just don't trust yourself with managing it, the money, maybe an annuity is something to consider. Okay, a couple more slides. Let's see how I'm doing on time. Okay. All right, people say to me, well, wait, Laurie, if I have $100,000 to invest, why should I put in the stock market? Why can't I just put it in real estate? Well, where I live, $100,000 isn't going to get you very far in real estate. Even $500,000 isn't going to get you very far. So if I were to look to buy an investment property where I live in Southern California, yeah, maybe I could find, a condo for $500,000. So you sort of need a lot of money to get started to be a real estate investor, to buy the actual property, unless you're in partnership with somebody or you're leveraging it. You could mortgage, right? I could put $100,000 down and own a $500,000 property. But what are the pros and cons? I've never been a landlord. If you read my book, you'll know that my mother's third husband was a landlord, and I've got some stories to share with you. I don't want to deal with tenants, toilets, or trash. I really don't have time for that. So that's the pro of the stock market, right? No tenants, toilets, trash. When I'm in the stock market, it's easy to diversify. All that whole list of things I showed you, I can be buying regular stock and companies. I can be buying bonds. I can be buying preferred stocks. I can be buying real estate investment trusts. I can move things around whenever I want. And I have instant liquidity. So my clients that need to take money out of the accounts, if they give me 3 days notice, sometimes 2 days notice, I can sell and generate enough cash, and they have that money. They can either ACH transfer it to their bank account or wire it. Can't do that with real estate. How often can you actually say, geez, I need money, I'm going to sell my real estate, and within 3 days you have cash? Ain't going to happen. And when in the stock market now, because of all the competition and where we're going for consumers, most cases there's zero commission if I have to sell something. There's some exceptions to that, but in most cases, there's going to be no commission anymore to sell stocks in most of the major brokerage firms. Selling real estate, don't I have to pay a real estate agent 6% or whatever it is, 5%? Don't I have closing costs? Here are the cons of investing in the stock market. Stock can be volatile. They go up and down. We had a crash last March. We had a crash in 2008, but we are way above where we were in those crashes. And then the cons are, your income is limited to dividends unless covered calls are used in order to generate more income from your stocks. Okay, I think I just have a couple more slides. Okay, so I'm not going to go into huge detail explaining what a covered call is because we don't have time, but generally, let me just walk you through this. I always think instead of renting out a property for income, I would rather rent out my stocks. So a covered call is when you buy 100 shares of stock in a company or an ETF, an exchange traded fund, and then I sell one call option, which what that means is, let's say I bought the stock Acme company at $100 a share. If I agree to sell it in the future at $105 a share, I've made a 5% capital appreciation, right? Because I'll be selling it at 105 and I bought it for 100. So I'll make a 5% gain. And I'm also going to get option premium, some amount of money to tell the other person, I agree to sell this stock to you at 105 in the future. And we decide what that date is. This is called an option chain. And I'm going to get immediate income. I might get $100 today. I might get $200 a day. I might get $300 a day. Why is somebody paying me money today in order to wait and potentially buy a stock from me in the future because they think the stock's going to go up more than 105? They may think this $100 stock is going to go up to 110 and they'd be happy to sell it or buy it from me at 105. So that's the whole thing with covered calls. I'm giving up some potential upside that the stock may increase in value in exchange for income today. And I can be doing this every month or every 3 months. And that's how I generate income for a lot of my clients who have stocks. Okay, I love this slide. I use it in my presentations. I've heard options are risky. And yes, they can be very risky. Often, I like to do the whole, it's really a stereotype, but a lot of people who are attracted to options, buying call options or buying put options, it's really gambling. They think that they can just invest a small amount of money and leverage it and make a 3x return. That's when you're buying options. Covered call is when you're selling an option. So just understand that, believe it or not, when you use covered calls, which is an option strategy, it's less risky than owning just stocks by themselves because I have 3 potential sources of profit when I write a covered call. The stock may go up in value, so that's capital appreciation. I may get a quarterly dividend from the stock every 3 months, and I get call option premium. The downside is that if I am so smart and have a crystal ball and I can pick stocks that always go up in value 10 or 20% every year, I would never do covered calls because I'd make more money on the capital appreciation of the stock. But how often does every stock go up like that? It doesn't. It doesn't happen very often. So this is a more conservative approach. Okay, that's a high, I gave you a total fire hydrant, but I just wanted to, at least introduce some concepts to you and some investment types that you may not be aware of. And we have 20 minutes left. And so Judy, I'd love to take questions, have a discussion. And again, if some of you are beginners and you might have only picked up 5% of what I said, some of you are advanced, and hopefully this presentation provided a little of something for everyone.
Exactly. Thank you so much, Lori. So informative. And everyone can also, if they have personal questions that are coming up on the chat, I will direct questions to Lori, but as they get very personal, please feel free to use the Savvy Ladies free financial helpline to really dive into your personal question. Lori, I'm going to begin with one question here that is asking around diversification. Do you think diversifying by having both traditional and Roth IRAs and CDs is a good idea to prepare for a retirement?
Great. So that's a great question. And this is a general one, so I can address this. So the questioner is saying a traditional IRA and a Roth IRA. And so a traditional IRA is when you get a tax deduction. You actually put pre-tax money into it, and you, so for instance, if I can put $5,000 into a traditional IRA, I get to, in most cases, there are conditions, deduct $5,000 from my taxable income. So I'm actually paying less in income taxes today, federal and state, if you live in a state that has a state income tax. And then it'll grow and compound. And then when I retire and take it out, I pay income taxes as I take money out. Whereas a Roth IRA, you have already paid taxes on the money. You don't get a deduction, but when you're older and you take it out, you never have to pay taxes on it. The best way to know what the ratio is for you is to be very smart and savvy ladies, about your income tax bracket, the thresholds for tax deductibility. If you're not comfortable doing that research yourself, your CPA can help you, or your financial advisor. And then the other part of that was CDs, and CDs are typically not in a retirement plan. They are typically cash savings. And if you don't think you can do CDs 1 year, 2 years, 5 years, if there's money that you don't think you'll need for at least a year, a CD is a great way to just get a little more income, a little more interest than you would in a savings account. So good plan, and just that's a great way to diversify the types of investments. And then within the IRAs, you can invest in stocks, bonds, preferred stock, real estate, investment trusts, almost all the things I mentioned.
Terrific. A question going back to the covered call. I think that is a new, maybe a new idea, a new concept for many people. I know it is for me as well. A little bit more on the details. Is that something someone could do on their own, or is it best to do that with an advisor by your side? And what are, as you did talk about the downsides of it, is it gambling? Should it not be done initially? Like, should that be, at what point do you do that in your investment strategy?
So great question. So yeah, covered calls is a sophisticated investment strategy. My book teaches how to do it. I've had, I don't know how many books I've sold so far, but I can tell you every month on Amazon, 10 more, I sell about 8 to 12 a month. I don't even market it. It's just, I guess it's recommended. So I've had plenty of people buy the book and they've done covered calls on their own just from the book. And I've had plenty of people say, I like it, but I want you to do it for me, or I want you to teach me how to do it. So I'm spread pretty thin these days. So I do work with a couple of other advisors at Coastwise Capital Group. And if you're interested in learning how to do it, we can coach you on that. Just depends on how many and what our bandwidth is at the time. So yeah, so basically, if you're interested in learning how to do it on your own, you can take some coaching with me or a colleague, or we can manage it yourself, or you can there's lots of online courses and stuff to learn about it, lots of books besides mine. It's like anything else, do it yourself or have it done for you, or some combination hybrid. Oh, and the downside, let's just say the risks. Covered calls are always less risky than just buying stocks themselves. So if you are already a stock market investor, covered calls is actually going to reduce your risk all the time. It's going to reduce your downside. That's just how it works.
And what sort of timeline should you give yourself to really earn those dividends, or earn that interest? Is it a short-term, long-term? Can you see something in 8 months? What is the timeline typically?
So it's, okay, so when you buy, if you buy dividend paying stocks, which you have to do research or work with an advisor to help you, stocks that pay dividends will pay every quarter, most of the stocks. So if you want to buy Disney or Starbucks, recognize that if that stock only pays a 1% dividend a year and you invest $100,000 in that stock, you're going to get $1,000 a year in dividends, or 2,000. So you can imagine it's a long game, right? There is no, I will tell you right now, I turn people away all the time, people who have sold a house and have hundreds of thousands of dollars. Like, as I said, if you're going to need the money that you're going to need to pay for your kids' college, to pay for a down payment on a mortgage, should be kept in savings. You can't take the risk. So any money you're going to need in the next 2 to 3 years, be very conservative with it. That doesn't mean, though, if you have $100,000 or you have $1 million and you're only going to need to pull out 30% of that, the rest can be invested more aggressively.
No, that's really, really helpful. We're getting lots of questions and a lot of thank yous here on the chat, Lori, that this is really, really helpful. And I think to round out the final questions are around the tax consequences of any of these investments. I know you mentioned it's very individualized based on everyone's own income. If you could address the tax consequences associated with this.
Okay, so a lot of people, so generally, if you're investing in an IRA, which is an individual retirement account, or you have a 401k or 403b at work, you're not paying tax on the investment income while it's in that retirement account. When you're 72, now the rules are changing every few years, but as of today, you are not required to withdraw from a 401k, 403b, traditional IRA, SEP IRA until you're 72. And when you start withdrawing money, you will pay income tax on that money. If you are investing outside of a retirement account, all the different stuff I mentioned has different tax rates. So let me actually just go back. I'm going to do real briefly. Let me go back to that page. When I invest in a high yield savings account or certificate of deposit, that's interest. That is taxed at the highest rates. That's taxed like your salary, right? That's going to be taxed at whatever income bracket you're in at the federal and state level. Some bonds, like municipal bonds, you pay no tax on. Depending on if I live in California and I buy or invest in California municipal bonds, I likely don't have to pay any federal or state income tax on that income. But the rates I'm getting are so low, I'm getting 0.5% a year in interest. Dividends from stocks are taxed at a better rate than bond interest or the CDs. This is why rich people invest in stocks, because because dividends from the stocks are taxed at a preferred rate, a lower rate. There's legislation now that may change all this. And then we get into these more complicated ones. You may get K1s, which are a real pain. I'm not going to get into that. What I will say with capital gains, so if I buy a stock at 100 and I sell it at 105, if I hold it more than a year, I will be taxed at a lower rate than if I hold it for less than a year. So you should be very aware of the tax consequences when you're investing. And people who are day traders get really confused. They could end up owing lots of money the next year, and they've taken so much risk that they've actually lost money and they owe taxes. You don't want to be in that situation. And I'm just having my cover slide here, my end slide, just for contact information. The best way to reach me is my website, theoptionslady.com. I have a monthly newsletter, but that's just the best way. Theoptionslady.com, you can find me.
Well, Lori, this has been truly really insightful for so many people here on the call today. We have recorded, and the recording will be available shortly on the Savvy Ladies website. Feel free to also visit the Savvy Ladies helpline. We've dropped the link in the chat here for each of you to use. We have an amazing community of volunteers. As Lori said, she is one of them. We have over 100 volunteers who are offering their time pro bono to offer guidance and help you answer your questions. If we didn't answer them directly today, we can answer them more personally, personalized to your question through the Savvy Ladies helpline. So please do visit us there. And I hope you enjoyed our Wednesday Wisdom webinar today with Lori.